What's up, YouTube? Welcome to today's video. So I came across this article the other day. Canadian consumer debt hits 2.36 trillion as mortgages and credit card spending rises. First, if you guys are into personal finance, investing, gold and silver, please like the video, subscribe to my channel, check out my website, My Road to Wealth and Freedom. The link will be down below in the description. Quick disclaimer, I'm not a financial advisor, so please do your own research and consult with a financial advisor before making any investment decision or pursuing any of the strategies discussed on this YouTube channel. It's for entertainment purposes only. So yeah, I've been going through the news lately, and I'm looking at this article from Yahoo Finance. Canadian consumer debt hits 2.36 trillion as mortgages and credit card spending rises. Let's kind of dig into this. So all year long, we've had central banks raising interest rates. I know here in Canada, they've raised interest rates quite significantly. In fact, just the other day, the Bank of Canada raised another 50 bips. Um, and it's just kind of, this will tie into the next article I want to look at. But, you know, the amount of debt in the system globally, never mind just here in Canada, but globally, um, makes every little, 25 basis point rise, 50, 75, that much more harder on the consumers, on governments, on businesses. Um, the, the world as I see it is, you know, in a huge debt crisis, the likes of which we really haven't seen in a very, very long time. Certainly not at this level. But you're literally going back to after World War One, possibly even World War Two. But what I'm looking at here is the amount of suffering and struggling that people are facing here in Canada and other over-levered economies like Australia, certainly over in Europe, um, which is why I've made it a point on my blog, on this YouTube channel, to really stress the importance of living within your means, not taking on or carrying too much debt, and spending your money wisely, saving, investing, just a really balanced approach, paying off debt, and not getting into debt. Because this is what happens. We've had record low interest rates for 10, 15 years now, especially since the pandemic. The, the Bank of Canada Governor Tiff Macklem was in the summer of 2020 telling people to go out and buy cars and buy appliances, go buy homes. Interest rates are going to be low for so long. And literally 18 months later, he's aggressively hiking into the worst inflation we've seen in 40 years. So that kind of caught a lot of people off guard. And it just kind of makes, you think you cannot trust certainly politicians or even bureaucrats because at the end of the day, they don't really know either. I think that's the thing that's kind of hit us in the last couple of years. You want to think that, people in positions of power and governments, they understand what's going on and to a certain degree can control or shape events. And that's usually not the case. More often than not, as we're seeing, is that they're always on their back foot, just trying to tackle whatever comes at them next. And even like the mainstream economists, a lot of those guys are like, just for instance, so here in Canada, home prices have fallen quite significantly this year. Some areas, so let's at least 20%, possibly more. But as late as last April and May, we're talking 6, 8 months ago, these same economists were telling us that, hey, don't worry, home prices are going to hold in there. Housing's not going to go down because, and they create these narratives. Oh, so many people are immigrating to Canada. That will prop up home prices. Oh, we have a housing shortage, and as I laughed at the time, I just said, the only shortage is a shortage of common sense. People are massively overpaying for houses at record low interest rates, and it was just a complete recipe for disaster. And now they're backpedaling on this stuff. If you go over, I'm looking at this other one. What's it say? Heads up, home buyers. Economists see more home price declines in 2023. I mean, these clowns are just riding the headlines. You know, what's the point, really? You can't trust a single. Most of these guys all work for, banks. Here's this guy, BMO Capital Markets. Oh, we're only about halfway there when it comes to home prices finding a floor. BMO's official call is for a 20% decline um, in the national benchmark. Now, I'm not sure if they mean from top to bottom or if they mean from this year to next. Because if that is the case, fell. Okay, so they're saying now in October the average home price fell to 756K from the February peak of 840. So that's about 10%. So they're saying another 10% to go. So you're really looking at about 675, 670 or something like that. The investor class is gone until this market gets repriced. Yeah, investors are bailing on the real estate market in droves for a variety of reasons. Number one, it's hard to make money when you have rent caps frozen, when you have house prices declining. You have to understand the real estate market in Canada. If you buy an investment property, whether you're buying a duplex, a single family home, a townhome or a condo or whatever, good luck cash flowing that. You will not cash flow that. In fact, you will be subsidizing your tenant. And the more these, ma and pa investors, the let's try to want to be real estate moguls, and I've been watching HGTV for 10 years. I can do it too. Good luck with that. You're taking on a huge liability, huge amount of debt, and you are literally shouldering all of that risk, all of the risk. If the tenant doesn't pay, screw you. You got to pay the bank. Interest rates go up, and you have a variable rate, or whatever your financing deal is. Screw you. You got to pay up. The government is limiting how much you can raise rents, and even if you do, the tenants don't pay. You go to the landlord tenant board, and good luck ever. We've been seeing it in droves this year and last year as well. Tenants refuse to pay rent. They refuse to move out. Homeowners are having to sell their own personal primary residence, and they're living in cars. And this is a complete disaster. And it just, again, like in Ontario and BC, certainly Toronto, Vancouver, Greater Toronto area, Greater Vancouver area. It's kind of like left-wing liberals that run the show down here, and it's basically, kind of like the New York, California of Canada. It's really hard to make any money in the real estate thing because as a landlord, you are taking on a huge amount of risk. You can be taken advantage of by tenants, by property owners, property managers, everything under the sun. But you really don't have any recourse. You just have to kind of take it, right? And of course, the landlord's always vilified, but it's not that way. And more stories are coming out like this. My point is, in the investor class, there's going to be a ton of distress selling, and the Airbnb stuff is imploding. All sorts of new rules. You can't have Airbnbs in condos, and just everything under the sun. So I would be very cautious on real estate right now, particularly in the overpriced markets of Vancouver and Toronto. Um, Maybe you can find something out in Calgary or in the Maritimes or something that might be worthwhile. But even those places have gone up quite significantly. Real estate across the board in this country has, gone up 40, 50% in the past 2 years. And it'll be interesting to see where this all goes. But in general, Canada has experienced at least a 20-year boom in real estate. So I want to go back to the Canadians in debt. Yeah, so Okay, in Q3, as inflation and higher interest rates, higher cost of living, um, consumers were turning to their credit cards, and we're seeing this in the U.S. We're seeing this all over the world. Um, let's see, it's a 17% increase, 21% increase from the pre-pandemic levels. Um, okay, people are buying, vacations and stuff like that, but they're also, it's just basic cost of living. Um, the average non-mortgage debt among consumers rose to the highest level since the fall of 2020 at $21,183. Insolvencies were also on the rise, particularly among young people and seniors who were feeling the strain of high cost of living and increased spending. So insolvencies are still below pre-pandemic levels. I just feel like this is all, if you're following me on this channel, if you're into, sound money and, the sort of Austrian school of economics and, sound personal finance and all that, I feel like so many of us in this space are just like, okay, when's it gonna crash? When's it gonna crash? And literally, what I've noticed, what I've seen, is this is a very slow moving train wreck. My last thing I saw, maybe 2 videos ago, I was covering how, you know, banks are stepping in and they're doing reverse amortizations. They're keeping people in their homes, keeping them from defaulting. They're adding interest, whatever they can't pay on interest on their mortgage. They're tacking that onto the principal and extending amortizations up to 40 years. And the CMHC insurance that homeowners who put less than 5% down, um, they have to have this type of insurance. It protects the lender, not the homeowner. But anyways, they're allowed to amortize up to 105%. And that's, backstopped by the Canadian taxpayer. So this is just like, it's going to take a little bit of time. People who can't afford their homes and can't afford their mortgages and cost of living today, they do have a little bit of runway. And the banks, it's not going to be politically palatable to have droves of Canadians getting foreclosed on. The optics of that just look terrible, and you bet that the government, the finance department, Bank of Canada, they're all going to be working with the big banks, CMHC, to try to ease, relieve, and find some solutions to keep this whole system from imploding. Whether or not they're going to be successful at that, I have my doubts. But the point is that this isn't something that's going to happen tomorrow. Home prices will continue to fall, I believe, even if they reverse course and stopped, with the interest rate hikes and started cutting them again. You know, where would we realistically be? Inflation is going to come roaring back, surging to new heights, and they're going to have to raise interest rates even more aggressively and even higher and higher for longer. So we're not even really in the thick of this yet. These are all, I guess, what all these articles, what we're seeing is these are just like cracks beginning to appear. Um, Insolvencies are starting to tick up, so you have the most at risk, the most credit unworthy people. They're starting to kind of fall off, but still not at the pre-pandemic level. So this is definitely a story for 2023. My guess is that it'll start falling apart in the spring because people can go 8, 9, 10, even a year, you know, um, before before they just kind of run out. They're done. Their HELOC is tapped. They can't access line of credit. Their credit card bills are building up. Um, you know, they're behind on utilities. They're behind on mortgage or rent. Like this is all still to come. And I think for the astute investor, for the cautious investor, the one who saves and is preparing accordingly, there's going to be lots of opportunities. If you're looking to buy into the real estate market, invest in the real estate market, you might be able to get that chance at much lower valuations and with a lot more distressed selling. know what you're doing, and if you can understand and weather the storm, and you have the liquidity, you're going to come out ahead for sure. It's always the name of the game, right? You just kind of sit back, wait, wait for that opportunity to come along. Too often in investing, I find myself, and you guys may find yourselves as well, you're trying to kind of make things happen. Like, I want to find that good investment. I want to do this. Oftentimes, the best investments are just when you sit back and just let everything crumble. And then you can kind of sort through the wreckage and find some gems. So that's kind of been my approach. I've been like really unhappy the last 2 years as everything soared to new heights. I find I'm the happiest when everything is in the gutter. Um, 2020 was a really fantastic year. I liked seeing the stocks take it on the nose, and all the chaos and stuff like that presents incredible opportunities if you kind of have a good sense of where you want to be and the moves that you want to make. So I'm definitely looking forward. I've spent the last few years tidying up my own kind of balance sheet. We paid off our mortgage. We're debt free. We have cash. We have physical gold and silver. Um, we have unlevered positions in our investment accounts and stuff like that. Like we're good to go, and I'm looking to really make up for a lot of the lost time, I guess, of the last couple of years. But let's continue on here. Car payments being missed more often. Financial stress related to autos also appears to be making a comeback. For years and years and years, we've had 0% financing on most vehicles, most models. Certainly, like the entry level models. If you want to drive a Corolla or a Civic or something like that, they usually make those 1% or 2% or 0 or whatever. But now I'm noticing if you want to finance, you're looking at basically 7%, depending on the vehicle model and whatever. So they're definitely being more pickier and choosy, and yeah. So, anyways, guys, that's it for today's video. Hope you guys enjoyed this discussion. I hope you guys are preparing and you're kind of getting yourself out through these holidays, through the holiday season here. I'm just kind of sitting back. I'm actually not really making any big investment moves. I'm very happy that I bought some gold back in October and in September, and even just more recently, I bought that little 10th ounce. But I want to just quickly comment on gold. Physical. Okay, gold's trading about 1810 US. Closed the week out, so it's really holding that 1800 level. I actually really don't care where this price is going to go. I have noticed though in physical gold, prices are up 10% across the board from just a month and a half ago. A lot of that is the paper price, went up. So I'm a little bit disappointed that I always wish you picked up a little bit more. But again, I'm just trying to keep my head on my shoulders, slowly but surely build wealth by saving, putting a portion of that savings into real assets, whether that be real estate or gold or silver. Being well positioned with commodity stocks, and which are super risky. I noticed, oil stocks have been getting killed. I think oil's at $72 a barrel. So there's, a lot of these commodity stocks. They're kind of, they're not really like buy and hold forever. You have to kind of be a bit more nimble. But interestingly enough, one of my best performers is Rio Tinto. I bought that in the summer, and it was yielding like 13%, and it's up quite a bit now. Very happy. I mean, they're a copper producer, and copper was under a lot of pressure a few months back. But just this whole world is really changing, and it will be really interesting to see what 2023 holds. But no matter what comes, I feel confident that I'm well placed to take advantage and to build wealth in just about any condition now. So it's a good position to be in. I hope you guys, if you're not already there, you guys can get there, and you get there by just being very, cautious, nimble, well diversified. That's it for today. Thanks so much for watching. Thanks so much for being a fan. Please like the video, subscribe to my channel, check out my website, My Road to Wealth and Freedom. The link is down in the description below. Cheers.